Cell 1. In this code cell, we're embarking on the development of a sophisticated approach to portfolio construction that resonates with the methodologies used by modern investment research teams. What we're creating is not merely another machine learning model. Rather, it's a compact representation of a comprehensive system that integrates data driven insights with human like reasoning to aid in investment decisions. At the heart of this approach lies the intention to strip emotion from the investing process. By eliminating emotional biases, we aim to base decisions on factual data and modeled scenarios. The workflow is designed to harness various sources of information, learning from historical performance while remaining adaptable to the ever evolving market conditions. This adaptability means that as markets change, our model is set to reevaluate relationships between different assets and adjust its strategies accordingly. An important aspect of what we're doing here involves exploring what if scenarios. This allows us to simulate different market conditions and strategies without placing real money at risk. Transparency in the reasoning behind decisions is another key feature. We want the model to not just produce outputs, but also provide insights into why certain choices are made. This makes our approach not only data-driven, but also more understandable for those involved in the decision-making process. Moreover, the framework we're establishing serves as a holistic decision support system, reflecting the ongoing evolution of quantitative research in finance. This is more than just a technical exercise. It's about building a robust tool that can navigate the complexities of investment with clarity and precision. Looking ahead, the next cell will likely dive deeper into the specific algorithms and methodologies we'll employ to bring this vision to life. We're about to explore the computational aspects that will aid in refining our portfolio strategy, furthering our understanding of the relationships between various financial instruments. Cell 2. In this cell, we're diving into the exciting intersection of finance and artificial intelligence through portfolio optimization. We aim to analyze different combinations of asset weights to find optimal portfolios that balance potential returns and risks effectively. By applying random weight distributions to a selection of ETFs and evaluating their performance, we can identify which configurations yield the best risk-adjusted returns. First, we import essential libraries, including NumPy for numerical computations, Pandas for data manipulation, and yFinance for fetching historical stock data. To handle potential warnings from the libraries, we suppress those to keep our output clean and focused. Setting a seed for NumPy ensures that our random processes yield consistent results, which is beneficial, especially when trying to replicate findings. Next, we specify a list of tickers representing various asset classes, including equities and commodities. The historical price data is downloaded starting from January 1st, 2015, and we calculate the daily returns based on the closing prices. This step sets the foundation for the upcoming analysis. The main logic unfolds in the portfolio performance function. Here, we calculate key metrics: compound annual growth rate, volatility, Sharpe ratio, and maximum drawdown. Each of these metrics provides insights into the portfolio's potential profitability and risk. For instance, the Sharpe ratio offers a way to measure return relative to risk, which is invaluable for informed decision-making. The Monte Carlo simulation begins with generating random weight distributions for the specified number of portfolios, in this case, 25,000. The weights are normalized so that they sum to 1, ensuring credible comparisons among variations. For each portfolio configuration, we compute performance metrics and store the results in a structured format for further analysis. Following the random simulations, we pinpoint the optimal portfolios. We identify which portfolio has the best Sharpe ratio, which minimizes volatility, and which exhibits the lowest drawdown. These findings are printed in an easily interpretable format, translating abstract numerical outputs into actionable insights. As we move forward, we will likely explore visualizing these results to better understand the implications of our findings. Incorporating interactive visualizations will allow us to analyze the relationships among different portfolios and possibly adjust our strategies based on clear visual cues. Cell 3. In this cell, we're visualizing the efficient frontier using a scatterplot generated by Plotly Express. This graphical representation is pivotal for understanding the trade-off between risk, measured as volatility, and return, represented by the compound annual growth rate. The efficient frontier helps investors identify portfolios that optimize this balance, which is crucial for effective investment strategies. The core of the visualization is a scatterplot that plots volatility on the x-axis against CAGR on the y-axis. Each point on the scatter plot represents a different portfolio option, while the color encoding reflects the Sharpe ratio, which quantifies risk-adjusted returns. By doing this, viewers can easily differentiate portfolios that offer better returns for a given level of risk. Alongside, we're including hover data for tickers and maximum drawdown, enriching the information available at a glance and allowing for informed decisions. A unique aspect of the plot is the highlighting of the portfolio with the best Sharpe ratio. We add it as a star marker, making it stand out distinctly. This visual cue is designed to draw attention to the optimal choice, grounding the analysis in tangible results. When we update the layout, we're also ensuring that our axes are correctly labeled for clarity, adding to the user-friendly nature of the plot. As you work through this cell, remember that while the efficient frontier provides valuable insights, the effectiveness of this visualization is contingent upon the accuracy of the underlying data. Anomalies or errors in your results data frame could mislead your analysis. In the next cell, we'll likely dive deeper into how to interpret these insights and perhaps explore additional metrics that could further inform our investment decisions. Cell 4. In this code cell, we're focusing on visualizing the optimal portfolio weights derived from our investment strategy, which is key to understanding how to allocate assets for maximum return. By analyzing the best Sharpe ratio, we can determine how to balance risk and reward effectively. The first step here involves sorting the weights associated with different assets in descending order. This gives us a clear picture of which assets hold the most value in our optimized portfolio. Next, we reset the index of this sorted data. This action organizes our data into a more accessible format, renaming the columns to Asset and Weight to clarify what each represents. It's also crucial to convert the weights into percentages, because presenting them this way helps users intuitively grasp how much of the portfolio each asset comprises. The real magic happens when we create a bar chart using these weights. By employing Plotly's capabilities, we're able to generate a visually engaging representation of our portfolio allocations. The chart's x-axis will display the asset names, while the y-axis quantifies the respective weights as percentages. Additionally, the text annotations will show these values rounded to 2 decimal places, enhancing readability. As we finalize the visual elements, we adjust the layout for better clarity and presentation. The completed figure serves as a powerful tool to quickly assess our investment distribution. However, it's important to remember that while this model is optimized, real-world factors can still lead to variations in performance. Looking ahead, the next cell will likely delve deeper into how these optimal weights can be applied in practice, perhaps by simulating potential returns or risks associated with the portfolio we've just visualized. This continues our exploration of data-driven investment strategies. Cell 5. In this cell, we're diving into a comparison between our optimized portfolio and the widely recognized SPY index. This analysis is crucial because it helps us visualize the performance of our tailored investment strategy against a major market benchmark, offering valuable insights into its effectiveness. To set the stage, we begin by calculating the returns for our optimized portfolio. This is accomplished by multiplying the returns data by the weights determined by our best Sharpe ratio. It's important to note that the Sharpe ratio is a measure of risk-adjusted return, and using it to guide our portfolio weights aligns our investment strategy with maximizing returns while managing risk. Next, we pull the returns specifically for the SPY, which serves as our benchmark for comparison. With both sets of returns in hand, we create a new data frame that holds the cumulative growth of a dollar investment in each option over time. This cumulative growth is calculated by taking 1 plus the returns and computing the cumulative product, giving us a clear view of how each investment grows over the same period. Now, we visualize this data using a line graph generated by Plotly. The graph is designed to be visually appealing, featuring a white template for clarity and dimensions that provide a comfortable viewing experience. The title succinctly captures the essence of what's displayed: the performance of our optimized portfolio versus SPY. The y-axis is labeled to clarify that we're displaying the growth of an initial dollar investment, which makes the comparison easily interpretable. As you review this visualization, it's essential to appreciate how the optimized portfolio stacks up against SPY across the timeline. The insights drawn from this comparison can inform future investment decisions and strategy adjustments. Looking ahead, the next cell is likely to build upon this analysis by exploring other performance metrics or perhaps incorporating risk assessments, thus enriching our understanding of how these investments are performing relative to each other. Cell 6. In this cell, we're diving into a visualization that compares the drawdowns of different assets, which is a critical analysis in finance. Essentially, drawdowns measure the decline from a historical peak and provide insight into the risks associated with various investments, helping us to understand their potential vulnerabilities. To create this comparison, we're working with a data frame where we're systematically calculating the drawdown for each asset found in our comparison dataset. The logic here involves taking each asset's value, dividing it by its cumulative maximum value, and then subtracting 1. This approach results in a metric that quantifies how much an asset has fallen from its peak, expressed as a fraction of that peak. We loop through each column of the comparison data frame, performing this calculation for all assets simultaneously. It's worth noting that when conducting this analysis, we need to ensure that our comparison data frame is correctly formatted and contains no gaps in data, as those could significantly skew our results. Once the drawdown data is prepared, we use Plotly to generate a line chart that succinctly displays these measurements over time. The visualization is set to a width of 1100 and a height of 600 pixels, making it easy to interpret. By labeling the y-axis with drawdown, we make it clear what is being measured, facilitating a better understanding of the drawdowns relative to time. As we move forward from this cell, we can expect to explore the insights gleaned from this visualization, perhaps looking into how different strategies might mitigate these drawdowns or highlighting key trends and observations that could influence decision-making in investment strategies. This sets the stage for a more comprehensive discussion on risk management in our upcoming analysis. Cell 7. In this cell, we're performing a regime scenario analysis, which is essential for understanding how different market conditions impact the performance of our investment strategies. By classifying market regimes, we can better evaluate our portfolio's returns against the backdrop of varying market environments, such as bear markets or periods of high volatility. To achieve this, we start by creating a copy of our returns data. We then calculate two key metrics, the 60-day return for the SPY and the 20-day volatility. The 6-month return gives us insight into medium-term performance, while the rolling standard deviation helps capture how volatile returns have been over a shorter time frame. These two metrics are pivotal for drawing conclusions about market conditions. Next, we introduce a function called classify regime, designed to classify each row of our dataset based on the calculated metrics. If the 60-day return drops below negative 15%, we categorize it as a bear or crisis regime. Conversely, if the return is over 10%, we see it as a bull market. High volatility is defined as a standard deviation exceeding 25%, while everything else is classified as neutral. This classification is essential because it allows us to better understand our portfolio's performance under various scenarios. After classifying the market regimes, we gather our optimized portfolio returns alongside SPY returns and regime information into a new data frame. This step is crucial as it prepares us to analyze how our portfolio holds up against different market conditions. We then calculate annualized returns for each regime, multiplying by 252, which standardizes our data to annual values. The results, rounded for clarity, are displayed to give us an immediate understanding of how different regimes affect performance. Then, we transform this data for visualization, preparing it for a bar chart. The visual representation allows us to easily compare how our optimized portfolio performs relative to SPY across various market regimes. As we transition to the next cell, we'll likely dive deeper into interpreting these visual results, discussing strategies for enhancing performance based on these insights, and considering how we might adjust our portfolio in anticipation of these market conditions. Cell 8. In this cell, we're constructing a comprehensive performance table that summarizes key financial metrics for different investment strategies. This is crucial as it allows us to compare the effectiveness of our PPO agent against a standard buy and hold strategy in the SPY index and an equal weight portfolio strategy. The stats table function serves as the backbone of our analysis. To break it down, the first step calculates the compound annual growth rate, or CAGR, which provides a sense of the average annual return of the investment over time. The function then assesses the investment's volatility, which is crucial for understanding the risk involved. We calculate this by finding the standard deviation of returns and scaling it to a yearly basis. Following that, we determine the Sharpe ratio, a vital measure that benchmarks the return against the risk taken. Next, we analyze growth over time with a cumulative product of returns, providing insight into how the investment accumulates value. Lastly, we calculate the maximum drawdown, which reveals the highest percentage drop from a peak, offering a glimpse into the worst-case scenario investors might face. Moving into the creation of the performance data frame, we gather statistics for the PPO agent's net returns, the SPY buy and hold strategy, and the equally weighted portfolio strategy. By transposing this data, we make it more intuitive to read and interpret. Each performance measure is multiplied by 100 for clarity and rounded for easier interpretation. It's worth noting that while this analysis provides a solid foundation, learners should be cautious about assumptions such as market conditions remaining constant or strategies performing similarly across different time periods. As we transition to the next cell, we'll expand our focus beyond traditional metrics and explore the intersection of reinforcement learning and sentiment analysis. This expansion promises to deepen our understanding of how these technologies can influence investment decisions and performance evaluation. Cell 9. In this cell, we're preparing a new data frame that pulls some key financial metrics based on historical returns data. This is crucial for assessing asset performance over various time periods, which can inform investment strategies. First, we take a quick look at the initial returns dataset using the print function, allowing us to understand what we're working with before diving deeper. Next, we create a data frame called features. The index of this data frame aligns with the index of our returns data, ensuring that the metrics we compute relate correctly to their respective time points. We then calculate several important measures. For instance, we're determining the 20-day rolling sum of returns for the S&P 500, represented by SPY, which helps gauge short-term performance. Similarly, we also calculate a 60-day rolling return for SPY to capture a broader perspective. In addition to returns, we assess the 20-day rolling standard deviation of SPY. This measure gives us insights into the volatility of the S&P 500 returns, which is vital for evaluating risk. We also gather corresponding metrics for other assets, the QQQ, the TLT, and GLD. Each of these shares the same 20-day rolling sum for returns, making it easier to compare their performances within a consistent time frame. After calculating all these features, we remove any rows with missing data by invoking the drop-NA function. This step is essential because it ensures that our final data frame contains only complete information, which will protect us from errors in later analyses. Finally, we display the first few entries of this features data frame, which should give us a compelling snapshot of our calculated metrics. Looking ahead, the next cell will likely build upon this foundational work by employing these features for insights into relationships between assets or for predictive modeling. The groundwork we've laid here will serve as a robust base for whatever analyses are to come. Cell 10. In this code cell, we are setting up a reinforcement learning environment specifically tailored for optimizing a portfolio. This is crucial because it allows the model to learn effective investment strategies through interactions with market conditions, which ultimately feeds into better decision-making in finance. The cell begins by importing the necessary libraries, including NumPy for numerical operations, Pandas for data manipulation, and Gymnasium for creating the environment. After aligning the returns with the features, we define a class called PortfolioEnv, which inherits from Gym's base environment class. Here, the emphasis is on constructing a realistic scenario where the model can simulate trading. Within the initialization method of the environment, we define the action space and observation space. The action space represents the portfolio weights assigned to various assets, constrained between 0 and 1. This allows the model to explore different allocations of capital across assets. In terms of observations, we utilize the features available to the model, which serve as inputs at each time step. The reset method prepares the environment for a new episode by setting the current step to 0 and initializing the weights equally among the assets. As the step method is called with a given action, the model calculates several key metrics. First, it normalizes the weights, ensuring they sum to 1. Then it computes the portfolio return, measuring performance based on the selected weights and asset returns at the current step. Transaction costs are also factored in, calculated as a percentage of the turnover, which captures how much the portfolio weights have changed since the last step. This balance between reward, which is the portfolio return adjusted for transaction costs, is fundamental to the agent's learning process. The code concludes by creating an instance of the environment and using the proximal policy optimization algorithm to train the model over a specified number of time steps. It's important to approach this with a robust understanding of how subtle changes in weights and transaction costs impact returns, as this is integral to learning optimal investment strategies. Looking ahead, in the next cell, we'll likely explore the evaluation of the model's performance, which will provide insights into its effectiveness and whether adjustments in training or strategies are necessary for improved outcomes. Cell 11. In this code cell, we're pulling together various components to evaluate the performance of a proximal policy optimization agent implemented for portfolio management. This involves extracting the trained weights from the model, conducting a backtest, and visualizing the outcomes. Understanding how the agent's recommendations translate into real performance is crucial for assessing its efficacy in a realistic trading scenario. First, we align the returns with the corresponding features to ensure that our data is properly synchronized for analysis. We then split the dataset into training and testing sections, using January 1st, 2021 as the cutoff. This division allows us to train the PPO model on historical data and subsequently evaluate its performance on unseen test data, emphasizing the importance of robust validation in machine learning. Next, we set up the environment specific to our training data and initialize the PPO model with a multi-layer policy. The model undergoes learning over a specified number of time steps, which represents a critical stage where the agent optimizes its strategy. Following training, we transition into backtesting the model on out-of-sample data. Here, the agent makes predictions based on the current observations and takes actions accordingly. It's vital to note how we handle cases where predicted weights sum to zero by redistributing them evenly across all assets to maintain a balanced portfolio. As we gather results from each step of the testing, we capture important metrics, including portfolio returns and transaction costs, into a structured data frame. We further calculate net returns and growth curves to compare the PPO agent's performance against common benchmarks like a buy and hold strategy on SPY and an equal weighted portfolio. This comparative analysis provides invaluable insights into how well the learning agent performs relative to traditional approaches. Additionally, we proceed to evaluate performance statistics such as the compound annual growth rate, volatility, Sharpe ratio, and maximum drawdown. These metrics encapsulate the risk-adjusted performance, crucial for both understanding and improving trading strategies. The presentation of this data in a table offers clarity and aids in easier decision-making. Finally, we visualize the learned asset allocations over the testing period, providing a clear picture of how the agent adjusted its portfolio weightings dynamically in response to market conditions. Ending the cell, we display the most recent recommended weights, encapsulating the ongoing adaptability of our trading strategy. In the next cell, we will likely delve deeper into refining these strategies or further analyzing. Cell 12. In this cell, we're leveraging the capabilities of the OpenAI client to forecast next month returns for a series of exchange-traded funds, or ETFs. This is significant in a financial context, as accurate predictions can help guide investment decisions amid fluctuating market conditions. The process begins by loading an API key from a local file, ensuring we authenticate properly with OpenAI service. We then initialize the client with this key, establishing a connection to utilize its powerful transformer model for our forecasting task. The heart of the cell lies in the prompt we craft, which outlines a specific scenario: elevated inflation and persistent interest rates coupled with a slowing economic growth trend. This context is crucial as it shapes the predictions we're seeking for the specified assets: SPY, QQQ, TLT, GLD, DBC, and VNQ. Once we send this structured prompt to the GPT model, it generates a response formatted in JSON, which we carefully parse to extract the expected returns for our assets. It's important to note that we check for valid JSON output, which protects us from potential response anomalies. If the JSON isn't present, we raise an error, signaling something went wrong during the model's response. Upon obtaining valid data, we transform it into a more approachable format by creating a data frame. This structure aids in making the output clearer and easier to interpret. We also convert the expected returns into percentage format, enhancing clarity for presentation. Finally, we display the refined results, which vividly represent our forecasts with neat formatting. Looking ahead, the next cell is likely to delve deeper into analyzing these returns, perhaps comparing them against historical data or market benchmarks to determine their reliability or potential strategies based on the model's predictions. Cell 13. In this cell, we're constructing a complex visual representation of asset relationships, which is crucial for understanding how different investments correlate with one another. This visualization will help us better assess our portfolio by examining expected returns and the suggested allocation of assets based on those returns. To kick things off, we first gather the assets we're interested in from the returns dataset and calculate their correlation matrix. This matrix reveals how each asset moves in relation to others. Positive correlations indicate that assets tend to move together, while negative ones signal they move in opposite directions. Next, we incorporate expected returns, which are sourced from a previous step, and we determine the allocation of these returns. If we have access to weighted allocations from a model, we use that. If not, we distribute weights equally among all assets. This leads us to create a summary data frame that includes each asset along with its calculated allocation, expected return, and a buy-sell signal, based on whether the expected return is positive, negative, or neutral. After setting up this foundational data, we progress to building a graph using NetworkX. Here, we add nodes for each asset and create edges between them based on their correlation with a defined threshold. Each edge represents the correlation strength, with the thickness and color of the lines visually indicating whether the correlation is positive or negative, as well as its magnitude. This way, stronger correlations will be portrayed as thicker lines, while weaker ones will appear more delicate. The next step involves creating traces for these edges, which entails defining attributes like color based on correlation values. We also prepare node properties, including size and color, that reflect the allocation to each asset and their respective signals. Green signals indicate a buy recommendation, while red indicates a sell recommendation, offering clear visual cues for decision-making. Finally, we assemble everything into a cohesive dashboard layout, complete with a summary table that provides all the necessary details at a glance, such as asset allocations and expected returns. The interactive graph enhances our exploration of asset relationships, giving us a deeper insight into how to adjust our investments based on current data. As we transition to the next cell, we may build upon this framework to conduct advanced analyses or introduce new data, refining our investment strategies further. This comprehensive approach ensures we're not merely reacting to market changes, but are well equipped to make informed, strategic decisions. Cell 14. In this cell, we're diving into the process of constructing a 6-month AI-driven investment portfolio. This is significant because it represents a shift away from relying solely on a single model, and instead incorporates various data sources such as historical market behavior, macro reasoning from GPT, sentiment scores from language models, and risk assessments based on volatility. This multifaceted approach aims to create a more robust portfolio that better reflects current market dynamics. First, we define a function to normalize the weights assigned to each asset, ensuring that they remain within acceptable limits. The function clips any negative weights and handles the case where the total weight sums to 0 by assigning equal weights to all assets. This step is crucial as it prevents any bias in the portfolio that might emerge from an unfounded distribution of weights. Next, we establish our asset universe, which includes notable options like SPY, QQQ, TLT, GLD, DBC, and VNQ. We then extract sentiment scores from our macro view, which quantify the market's perceived outlook on each asset. By normalizing these scores, we transform them into a consistent scale, allowing for easier comparison across assets. We further enrich our analysis by re-indexing expected returns based on GPT's macro analysis and the historical average returns from our asset data. This combination yields a blended expected return that weighs the GPT predictions at 40% and historical values at 60%. Then we create a scoring system that combines various factors: half from expected returns, 30% from sentiment, and 20% from a risk measure based on volatility. This score is vital as it informs how we will distribute weights across the various assets in our portfolio. Finally, we normalize these calculated weights to ensure they sum to 1, providing a clear view of the potential investment distribution. The results are then organized into a data frame, which displays each asset's weight, expected return, sentiment score, and overall ranking. This clear presentation allows for quick and informed decision-making. Looking forward, the next cell will likely build on this comprehensive scoring and weighting methodology to simulate or analyze the actual performance of this newly formed portfolio in various market scenarios, helping us validate our current strategy. Cell 15. In this cell, we wrap up our discussion by emphasizing the significant role artificial intelligence plays in synthesizing information, evaluating different scenarios, and aiding in portfolio decisions. This focus not only enhances the credibility of our project, but also broadens its appeal to a larger audience, bridging the gap between technology and finance. We highlight an important caveat. While AI offers powerful tools for analysis, it remains a nascent technology. This means it is prone to errors, sometimes referred to as hallucinations, where the system might produce outputs that don't accurately reflect reality. This distinction is crucial for users to understand, as it underscores the importance of critical thinking and verification when leveraging AI-driven insights. Additionally, we clarify that our work is not intended to serve as investment advice. Instead, it acts as a demonstration of how investing operates in practice, underlined by principles of risk management. This interdisciplinary approach, bringing together computer science, finance, and statistics, empowers individuals to make informed decisions while navigating potential uncertainties. As we move forward, the next cell will likely explore practical applications of these concepts, diving deeper into how to effectively utilize AI in real-world investing scenarios. This will help us better grasp the balance between leveraging technology and maintaining a cautious, informed perspective. Cell 16. We have reached the end of the notebook.